When buying a home, taking a mortgage is a very important part of the decision and the choice. Choosing which mortgage is right for you is so important and has detrimental impact on your purchase and the upkeep of your property or the decision in the future. Welcome to The Brief. I'm Makram Hani, analyzing property, and today we'll be talking about the 3 mistakes you do yet need to avoid when taking a mortgage tomorrow. Mistake number 1, choosing a variable lower interest rate rather than a slightly higher fixed interest rate. And in your opinion, you're saving on interest. In an environment where interest rate is ever evolving, especially today where it's rising, it's better to fix your interest rate for a period of time. If interest rate drops after a point of time, you can still negotiate and do a buyout. Yet, if you have a variable interest rate and interest rates hike, you can never renegotiate and fix the interest rate at a lower one. You will always be paying higher than the market. So, in my opinion, you always need to fix the interest rate for the longest period possible, even if at slightly a higher rate. It offers you happiness as an investor and security as a family. Remember, real estate is a long-term game, is not a blip for tomorrow morning. Mistake number 2. Take a short-term mortgage. So rather than getting a 25 or 30 or 35-year mortgage, you take a 5, 7 or 10-year mortgage. This is very harmful, although I know what you're thinking of. You're thinking of paying off your mortgage at the fastest pace possible. Yes, in very rare cases, this may be beneficial. But in general, this is harmful because it carries out a higher burden on a monthly basis being paid by you, even if you're an investor or an end user. You need to reduce your monthly burden so that you cash flow better. At the same time, you need to extend the time that you pay the mortgage back with, because then you'll get the real benefit of having a mortgage, having property leveraged. Why? You know my theory. You're getting an asset at the price today, and an asset which is in general appreciating in value. You're paying for it at the price today with a small margin, which is the interest, using a currency which is by nature devaluing, depreciating in value, and in general, this depreciation is higher than interest rates with margin. And you're paying for it tomorrow. Mistake number 3. Take a mortgage with an interest rate that's linked to an internal bank rate rather than to IBOR, which is the interbank offer rate. An interbank offer rate is set by central bank and has a straightforward formula to set it and to decide it, and in general is public and capped. So if you pay based on IBOR, you pay IBOR plus a margin, which is the bank's margin. You're paying a fair rate at all times. If you're paying an internal bank's rate, you have the rate decided by the bank, which is your lender, and the algorithm or the formula that they can change at any point of time. Pay always based on a fixed IBOR, better than paying less on a moving internal bank rate. This has been The Brief. Makram Hani, analyzing property and talking about 3 mortgage mistakes that you need to avoid today. I hope that added value to you. Ciao.